Okay, this is still part 1. This is a depreciation question, and its effects on a tax liability. So the question is, a company has purchased an asset with 10-year useful life. It will use an accelerated depreciation method for the tax purposes. For reporting purposes, it will use straight line depreciation because the method is balanced. The method is believed to reflect better the usage of the asset over its economic life. Okay, so two things are happening. Two policies are in effect. One is accelerated depreciation method for tax purposes and straight line depreciation method for internal purposes, I guess. So during the 10-year life, the asset, the company will report as different tax as an amount that is. So here's the required. The required is during the 10-year life of the asset, the company will report deferred tax an amount that is constant. Well, I was thinking just because I picked that, I knew I was wrong. I wasn't 100% sure. It's because it can be constant. It can only be constant if we were using the depreciation method, straight line depreciation method, for reporting purposes, because then every year is the same expense. But it is specifically talking about the other one, which is the accelerated method for tax purposes. So I did not read well the question. I should have focused what is really asking. So that's why reading the required is really important. So it was asking for the 10 years life of the asset, reporting as a deferred tax. Okay, get that right first, okay? Next is just doing a graph about it, so to understand this better, this is a line of best fit. As the useful life of the asset increases, eventually it will decrease to an amount of 0. The tax depreciation liability, and on the left is just something that's happening in between, is the depreciation is larger than the book value initially in the initial years, and then it becomes to be like in the middle, and then it goes down to 0, like what's happening on the right. So you gotta look at the whole picture and look at the required, look at the problem, and solve it according to the problem, because I would have had the question right because my answer was right as a constant, but I did not read the required right. So you gotta read the required right. So it was asking for the tax deferred liability reporting policy. Okay, I hope that makes sense. So C, read their question right, and then because the company uses accelerated depreciation method tax purposes and straight line method for book purposes, the depreciation expense for tax purposes will be higher in the earlier years of the book depreciation. This will lead to taxable income before being lower than book income. The company will therefore have a deferred tax liability in the earlier years. Then this deferred liability will increase during the year in which depreciation is larger than the book depreciation. However, in the later years, the asset's life, when book depreciation exceeds tax depreciation, the deferred tax liability will decrease until it becomes 0 at the end of the useful life of the assets. That's why for me, like, what worked for like drawing this graph to see like the effect of useful life increasing on the left, like over here, and then like how the line of best fit comes here, and then and the tax depreciation liability kind of like decreases down, like kind of goes down. So that's what explains, that's why I knew that like the two different policies will have two different effects. Okay, and probably for the straight line method, it would just be like a straight line, because every year the expense would be same. Okay, I hope that makes sense. Adios amigos.